Hi, and good afternoon, everyone. My name is Maddie Yaskowski. I will be the moderator today. Thanks for joining us for this webinar, Adapting to the Impacts of COVID-19, Building Your Digital Mortgage Roadmap, hosted by Actualize Consulting's Matt Su and Falcon Capital Advisors Camelia Martin. It is 2 o'clock now, so we're going to go ahead and get started. Before we do, I just wanted to mention that you can ask questions as we go along by using the chat feature that you see on your screen. And this presentation will be recorded so you can rewatch it later. Without further ado, I'm going to introduce both of our hosts. Matt Su is one of two partners at Actualize Consulting. He is responsible for managing Actualize Consulting's accounts with focus on the GSEs, mortgage companies, Wall Street broker-dealers, software companies supporting the fixed income and mortgage arena, and all MISMO service and technology offerings. He is the chair of the MISMO Strategic Planning Committee, and prior to Actualize Consulting, he served as a vice president for Freddie Mac, where he focused on large-scale business and technology change efforts. He was responsible for redesigning a significant portion of Freddie Mac's single-family and structured finance operational infrastructure, and also served as head of the Corporate Enterprise Data Program, where he was responsible for all data management and data governance activities across the company. Camelia Martin is the managing director for Falcon Capital Advisors and leads their digital mortgage advisory group and works with all types of mortgage industry participants to facilitate their digital mortgage adoption efforts. Martin is regarded as a leading subject matter expert in the implementation of digital mortgage closings and eNotes. Her experience includes industry-wide initiatives which have directly supported digital mortgage acceptance programs for key participants such as Ginnie Mae and the Federal Home Loan Banks. Martin was selected as a 2020 Housing Wire Woman of Influence in recognition of her efforts to support the industry's adoption of digital mortgage closings. She also currently serves as a member of MISMO's Strategic Planning Committee. Both Matt and Camelia have previously partnered on many things and have worked together on digital mortgage, MISMO, and both were co-chairs of the digital loan modification for MISMO. As an overview of the presentation today, Matt and Camelia will discuss the state of the industry, progress in digital mortgages and eClosings, what's on the horizon, and digital roadmaps and why they are critical. So I will go ahead and pass it to you, Matt and Camelia.
Thanks, Maddie, for the intro. I wanted to start the presentation off by taking us back what seems like a lifetime ago, although it was really only 9 months back in February. And things were going well. The stock market was getting to all-time records. We had a good mortgage environment. Unemployment was at all-time or historically low levels. Everything was great. And then we end up with this pandemic, which nobody ever really would have predicted. And what happened was a handful of things intersected in a way that at the time seemed to be very negative, but at the end of the day, they shifted to a positive, which we'll go over in a minute. But if you remember back in March, in order to stimulate the economy and provide income and funds back to folks that were unemployed as well as businesses, there was a very quick rate reduction as well as a lot of stimulus money went out. And with that, you saw that mortgage rates started to move down in relation to the rates that were cut by the Fed. The problem is that in that time period, the market really wasn't looking at a refi wave in the near future. And so it started coming. And what you realize when you look at what we had, and California was first, and it moved into more urban areas, New York specifically, and even in this area in the DC market, where we saw things like shelter in place. So that's hard, right? It's difficult to do things like appraisals. It was tricky to get people to order an appraisal and have somebody come on site to their home. Similarly, and we'll talk about this at length, how do you do things like a closing of a loan when you don't have the proper digital technologies and capabilities? Further, I think, if people remember back, it was tricky to get funded because of the number of things that had to be jerry-rigged. It was difficult getting your warehouse line released. And so some companies were even worried about whether they'd be holding loans, and some just started to get out of the business. I'd also say that, one of the things that the primary market does when things like this occur is they tend to not lower rates as much as they maybe could have. And so, with that, we saw some companies that were very aggressive showing 30-year product at 2.5, while others still were at around 3 or 3.25. And so what I talked about then was I thought that, we would probably see as the processes started to streamline, that you may see rates drop some more. If you want to move, Maddie, to the next slide, we can talk a little bit then about what happened. So in April, miraculously, companies started to close loans, and they did so by using digital technologies and leveraging things like online notarization. And I know for sure a couple of the companies that I worked for, it was like, the Wild West. They weren't necessarily prepared for this. Yet by the middle of the summer, we saw an awful lot of things close. And Camelia is going to go over that in just a minute. And so now we're here in November, and rates are at very low rates right now. I think we'll talk a little bit about a refi wave on the horizon in a while in the presentation. But I think now it's really going to be a matter of seeing, what's going to happen in the market relative to additional policy changes. Obviously, with presidency still up for grabs, we can't make specific predictions. But if you believe that Biden wins, then probably more movement to try to get additional stimulus out there to make sure that folks are still in good shape financially. So I think, again, we would have hoped that by the time we had this presentation that we had a real winner, but we'll just lean towards the Democrats. We'll see in Georgia, but again, no crystal ball here, but we'll see soon what happens. So Maddie, if you'd like to move to the next section. So I think, I'd mentioned this a second ago, but I think what we're going to see in 2021 is I see that we could probably have a little bit of a bump and a continuation of another refi wave. I think you're going to see a lot of loans that were in forbearance. Quite frankly, the borrowers may or may not really have had true hardship. And so if you think about a cohort of borrowers, let's just use 30-year notes that were at 3.5 to 4, I could see very quickly that as folks come back out of forbearance that can pay, they will seek to get into these loans that are now in many cases below 3%. And so, I think that we're probably not out of the woods in terms of the volume, but at the same time, we've seen a pretty good movement and a maturity towards leveraging the digital concepts. So, Maddie, would you like to go to the next slide? I think at this point, I'm going to hand it over to Camelia. And as mentioned, a lot of Camelia from the industry, and we did a similar presentation way back in the late springtime about this same thing, and we were forecasting what was going to happen, and I think a lot of it came to pass and was reality. And so, Camelia, why don't you start off by telling us a little bit about the basics, and then go through and tell us how things have played out during that time between the original pandemic and now.
Sure. Thanks, Matt. And building off of something you just said, I think, as we sort of predicted when we did this about 6 months ago, we'll call it a silver lining in all of this, is that there was certainly this new renewed emphasis on lenders and settlement agents' abilities to support eClosings. As Matt mentioned, everyone's looking a way to make sure that business could continue as usual. How do we either reduce or eliminate physical contact at the closing, make sure that closing can still occur. But before we really dive into those topics, I'd like to describe what an eClosing is and what some of the key eClosing components are so that we're all speaking the same language. So an eClosing is any mortgage closing where one or more of the closing documents are electronically signed. So a key point there means that this is not necessarily an all or none approach. If any of the closing documents are wedding signed, but some of the closing documents are e-signed, that's referred to a hybrid eClosing. And then if all of the closing documents are e-signed, none of them are wedding signed, that's typically referred to as a full eClosing. You can move on to the next slide. So this is another list of key eClosing components that are worth familiarizing yourself with. I'll go through these rather quickly, and I think they'll become more relevant as we progress in the conversation today. But when we say e-signature, we're talking about an electronic signature that's defined as a sound symbol process that's attached to or logically associated with a contract or record. And it's being adopted by the person, in our case, the borrower, with the intent to sign that record. So that's what's taking the place of the wedding signature. Then you have the eNote. I'm going to skip around a little bit here, but an eNote or an electronic promissory note is the equivalent of the paper note. So it's created, presented, and signed electronically. It has all the same types of terms that you would see in a paper note. One key difference is that the borrower is acknowledging in the body of the note itself, there's text where they're acknowledging they're signing an eNote, and that the system of the record for the eNote will be the Mersey registry. And we'll talk about that some more in a minute. So when you hear the term e-mortgage, that is commonly defined as a loan where at least the note is an eNote. Then there's tamper evident seals, and that's just basically a unique digital thumbprint that is applied to an electronic record after the borrower has signed his or her electronic signature. Now, why this matters is that this is what's giving lenders, investors, really any downstream counterparty, this mechanism to ensure that no one has modified that document after it was signed. And then to talk a little bit about the e-notarization concepts that Matt introduced at the beginning. In an e-closing, when that document needs to be notarized, and the document that needs to be notarized, I should say, is e-signed, then at least one form of e-notarization must be utilized. And there's currently two types. We have in-person electronic notarization. As the name suggests, the borrower and notary are in person, co-located, and the notary is applying his or her signature and notarial seal through electronic means. And then you have RON, remote online notarization. The borrower and notary are not co-located, and instead they're viewing one another through an audio-video feed. But once again, the notary is applying his or her electronic signature and seal to that record electronically. For any closing documents that are electronically signed, if they also need to be recorded, then you need to make sure that you're in a jurisdiction that also allows for e-recording, where the recorder's office is willing and able to take the electronic record and record it. There are a few exceptions to this. There are some areas that permit paper out recording. So they take the electronic record, they create a paper rendering, and then there's a process to certify that it's a true and correct copy of the electronic record. But for the most part, e-recording is widely available, especially when you look at it from a population standpoint. You may have recently heard another term, it's not on the slide here, RIN, or remote ink notarization. And the reason why we're not going to talk about it too much is that's not a form of e-notarization. It's involving the borrower appearing before the notary in an audio-video feed similar to RON, except that they're wetting signing a paper document, shipping it off to the notary, who's then performing a traditional wet ink notarization. So that's one of the reasons it's not considered a form of e-notarization. And And we have eClosing system. So eClosing system is a secure portal that's being used by the borrower, the settlement agent, maybe even the notary to facilitate the presentation and the e-signing of the eNote and the other records during the closing. And these last two components are specific to eNotes. So if your eClosing is going to include an eNote, then you start introducing the concept of needing to have an eVault and needing to have that eVault integrated with the merge registry. And the reason for that is the eVault is helping you validate the tamper evidence seal of eNotes. It's securing your copies of eNotes in a way that maintains their integrity, helps you comply with certain e-commerce laws. And the eVault is also currently the mechanism that's being used by the industry to initiate transactions to the merge registry. So we keep talking about this merge registry, and the purpose of that registry is it serves as a system of record for parties that have certain rights to eNotes. So unlike a paper note, where there's one original wedding signed copy, and whoever's in possession of that is the party that typically has the rights to enforce it. You know, with eNotes, you have hundreds of copies, just like any other electronic record, and they're all virtually identical to one another. And so when you go and look at these e-commerce laws, they call for a mechanism or a system where you can identify the party that has the right to enforce that eNote, that transferable record, and the e-registry is a big part of that system. And then lastly, you have merge delivery. And merge delivery is just a secure mechanism. Again, it's going through your vault, but it's giving you a mechanism to transmit copies of eNotes and other e-mortgage documents between your counterparties. And next slide, please, Maddie. So when you look at this next chart, this is what can be really surprising. You might look at this and say, why are there so many different types of eClosings? So the eClosing components that we just talked about, let's just take a couple of examples. If you're in a jurisdiction that doesn't allow for e-recording, then your recordable documents need to be wedding signed and traditionally notarized. So in that example, as long as the counterparty will accept an eNote, you could still have the fifth type, for example, of hybrid eClosing in this chart, where all of the non-recordable documents and the note are e-signed, but the notarized docs, which are typically recorded, are wedding signed and traditionally notarized. Or maybe a better example, let's say you're in my home state of Virginia, where we both have RON that's permitted, e-recording is widely available. Let's say the end investor is one of the GSEs, either Fannie or Freddie, both of which accept eNotes and RON. You could have a full digital closing one, very top there. All of the closing documents are electronically signed. The notarization occurs through remote online notarization, and the borrower never even has to leave it. So what we're really just trying to illustrate here is that despite all of the variations in counterparty acceptance policies, e-notarization laws, e-recording policies, capabilities of lenders and settlement agents, eClosings have found a way. And as more and more of these laws and policies start to align, the bottom half of this chart should start to shrink. Next chart, please.
So Camelia, we do have one question. It's, what are the benefits to hybrid digital closing if you can't be fully digital?
It's a great question. So there are significant lifts that you can get. Let's, for example, say that you can just go with eNote. The common denominator for you with your investors or your counterparties are, you know that you can do an eNote, but maybe there's not instances where you can always have the notarized or recordable documents to be e-signed. So in that example, you still are in a position where you can have that note back instantaneously post-closing. And why that's relevant is you're not waiting to get that original wedding paper note back from the settlement agent after closing. So now you can transfer that eNote to one of your counterparties, like your warehouse lender, within minutes. And in turn, you can that warehouse lender can transfer that eNote to a GSE who will fund an eNote within 24 hours. So when you look at the time frame from when you originate a loan to when it's funded and when it's off your warehouse lines, what those savings might look like for you obviously will be different from organization to organization, but that's where you can start to see all of these little lifts and all this ROI start to happen, even if you're at a hybrid. And again, like thinking about it also from like a borrower experience perspective or from these shelter-in-place orders, maybe you can't get that closing appointment to not be in person at all, but maybe you get it down to 15 minutes. Maybe they just have to show up and sign 1 or 2 documents instead of a stack of paper. So those are the types of things that organizations are clearly seeing the benefit from, either from competitive advantage, certainly there's operational efficiencies, but the method or the type of hybrid that might make sense for your organization and where you're going to see those wins could differ. But you're also getting a win just from getting the experience and sort of inching towards that full digital closing. Thanks for that question. So I like these next charts a lot because they do all the talking for me. And since we have that MERGI registry, which is the national system of record for parties with rights to eNotes, it's a lot easier to track the growth of eClosings that include an eNote, because we have here the number of unique eNotes that are registered on the MERGI registry. So if you look just a couple of years back, and this is something Matt alluded to at the very beginning, in all of 2018, we had just 17,000 eNotes. In 2019, that number jumped to over 127,000. And this year, just to the end of October, we're already at 353,000. So that's nearly a 275% growth year over year. Now, what these numbers don't show just yet is that also in the last year, the number of participants that are active on the MERGI registry has nearly doubled. So it's going to take some time to see some of that ramp and see that effect, the effect that these participants will have on this eNote activity. But we know from past experience that it will have a compounding effect, because with each new counterparty that goes live with eNotes, other participants that work with them are now able to increase their eNote and eClosing volumes as well. Next slide, please. So this is the last stat I'll share, I promise. But this is also interesting. So the FHFA's OIG just published a white paper a couple months ago and noted that purchases of e-mortgages by Fannie and Freddie had increased substantially to $38.8 billion, or 4.25% of all single-family loan purchases. And this is just through the first 6 months of 2020. So this is up from 2.7 billion, or 0.4%, in all of 2018. And in that paper, both GSEs also added that they forecast that these e-mortgage purchases will reach at least 5% by the end of the year and continue on an upward trajectory into 2021. One more note here is the GSEs do a tremendous job of putting out e-mortgage resources. So if you're a Fannie, Freddie seller servicer and you haven't checked out their respective e-mortgage websites, I encourage you to do so. Next slide. So all of the activity we just talked about, looking at other factors that will further compound this growth. In November, you had MERS releasing a new feature on the e-registry that's going to allow, or that allows parties with a security interest in an eNote to be named on the registry. So why this matters is that this directly supported the adoption of eNotes by the Federal Home Loan Banks and by Ginnie. So you'll note here, Federal Home Loan Bank of Des Moines went live on July 1st. Ginnie Mae announced their digital collateral program on July 17th. Federal Home Loan Bank of Dallas followed on July 21st, and then Chicago on August 3rd. So all in, just more support in the form of policies and infrastructures that will pave the way for greater adoption. And Maddie, feel free to stop me if you get questions, but I'll just keep going. So to get a little more tactical here, we wanted to illustrate the two workflows for a paper note and an eNote side by side. As we already discussed, one key difference is an eNote is electronically presented and signed, whereas the paper note is printed out and wet ink signed. After the eNote is signed, a tamper-evident seal is digitally applied, it's stored in the eVault, and through the eVault, it's registered on the e-registry. This is typically a function that's automated. For the paper note, it has to be shipped from settlement to the lender, from lender to the warehouse lender, and then from warehouse lender to the investor. Not to mention all the scanning that happens in between. Also for a paper note, it has to be endorsed. But with an eNote, the process for endorsement and delivery is replaced with transactions on the MERSI registry and MERSI delivery. And so those transactions can happen intraday. They happen within seconds or minutes. There's no shipping, there's no scanning, and there's no missing or lost collateral. And we'll talk about this sort of on the next slide. Actually, Maddie, you can go ahead and go to it. But one of the big benefits and risks is that there's a huge lift when it comes to QC. So the version of the eNote that's used today is a smart doc. Smart docs have a data layer, a view layer, and then they have a layer that locks that data and view together. So what this means is your eNote is really just data. And now you can take that data and more readily automate your QC processes by comparing it to any data that you have in your internal systems. Exactly what the GSEs do today. They auto-certify eNotes that they receive against their internal proprietary systems. There's no more risk of getting documents back from closing with missing or incorrect signatures. So eClosings inherently prevent that type of activity. They prevent things like the borrower can't all of a sudden sign with a different name than the name that you had on record. And I think we mentioned earlier in the presentation, you're not waiting to get original wet ink signed notes back from settlement. It's immediately available because it's stored in your eVault. Next slide, please.
Camelia, we actually have one question. So what is the reaction from the borrower community on eNote?
Yeah, so this is an interesting question. We get this from time to time where folks say, well, will the borrowers adopt this? Will they be comfortable with it? And I think that borrowers are already doing business electronically. They started the loan application process through point of sale electronically. They might have even signed their disclosures electronically. And then they end up at the closing table with the stack of paper. And so I think it's actually something that they're going to be more comfortable with. But certainly the borrower still has the opportunity to opt out or to consent to the eClosing. And that's something that, that process doesn't go away. So you still need a process early on in your pipeline to identify good candidates for eClosings, to socialize closing options with your borrowers. But I think what we found is by and large, and let's think about the current environment, for example. If you knew that you could get the same loan for the same rate, and in one example, you didn't have to leave your house and you could do it, from your home on your own schedule, and then the other you had to drive across town and spend an hour or two at a settlement agent's office. I think the answer for most of us is obvious. You still could have individuals, and there might be people that will still want, opt for a traditional in-person wedding closing, and I think that's fine. But I think by and large, that's going to start becoming the unicorn rather than the norm.
Thank you.
So the last thing I'm going to talk about today is how we approach eClosing and eMortgage adoption efforts. I think, hopefully if you've signed up for the webinar today, likely you're past the point of needing to be convinced that you need to make this transition. Maybe you're just looking for a roadmap or some ideas on how to implement and how to get there. And the first factor you need to really be thinking about is your trading partners or counterparties. So how are they? What are their eMortgage acceptance policies? What percentage of your loans go to them today? And you need to take an inventory of these trading partners. And once you understand their readiness and their policies, that's going to be a big factor into how EU can be. Another big factor into how EU can be is regulatory or jurisdictional. So this is the where. So not who your loans are going to, but where you're originating loans. So which states are you originating loans in which counties do you have the highest concentrations, things like that, so that you can consider the status of those e-notarization laws and those e-recording policies we just talked about. Technology might be the obvious one here, but this is really taking stock of the features that your existing providers, like your LOS provider, might have or might be able to offer, determining what components you will need, and depending on the types of eClosings you wish to support, that's going to be different. I don't recommend that you go to this step until you first determined how you can and want to be, and that again is going to be heavily driven by those first two factors that we just talked about. Operational is an honest evaluation of your operational readiness and maturity to implement eClosings. The questions you need to ask yourself here are, how well documented are your existing procedures and workflows? Are you already in a state of flux in your operations? Are you implementing some other broad scale change? This is critical to the impact analysis and the business process reengineering efforts that you're going to need to be able to perform to support eClosings and eMortgages. And last but not least, we have vendor. So we define vendor a little differently here than you might think. This is anyone that provides a service to you related to your loans, but doesn't have an interest in the loan itself. So in this category, you might have a subservicer, you might have a custodian, you might have a QC vendor. And the question you're asking here is, what are their capabilities? Will they still be able to provide the services they're providing me today if this is an eMortgage, for example? And a factor that isn't necessarily listed here, and one that I'll hand back to Matt to talk more about, is how market conditions might color your approach to eClosing and eMortgage implementation. So all those factors that Matt talked about at the beginning, how that might change or might not change the direction that you might take your implementation efforts. So I'll hand that over back to you, Matt. Thank you.
Thanks, Maddie. If we just flip through to the next slide. I think, we talked a little bit about this. I want to just talk about what we're looking at going into next year and the next several months. We talked a little bit about forbearance. I'm one of these folks that thinks that we'll come out of this nicely and that there'll be a lot of refinances. There are definitely going to be some borrowers, especially if we keep a prolonged unemployment situation, that will actually need to be modified or go into default and liquidation. But I think given the rate environment, and I don't see the rate environment climbing anytime real soon, given where we are in the economy, that I think we have a chance to really keep rates low. And as I mentioned, I think we're going to have a nice little refi wave in the first 6 months. And then, let's be frank, I think you're going to be in a purchase market for a long time. Rates are so low, it's hard to imagine a whole lot of refi unless it's simply cash out. But I do think that we've got a lot of momentum. And the reason why I believe that is we've just seen an awful lot of interest in market participants in the lending community in trying to shore up what they're doing in terms of this. In addition, same thing on the vendor side, companies that have traditionally not been involved in this as much are looking at it, and others that may not be in a great financial position are trying to figure out what to do. I think it's also interesting to note, and you've seen how both ICE and Black Knight have been acquiring companies to fill out a puzzle. I think that you're going to see a similar thing happen with the digital technology space. I, for one, believe that much of it is a commodity. I think there's a level of complexity that exists that creates some types of, belief that these are niche-y and that they're going to remain. But the reality is it's not complex technology. And so my belief is that we're going to see some shakeout in the market, a consolidation of the providers, the ones that Camelia talked about. And I think that we are going to start to see, as a digital mortgage concepts continue from loan application through closing, I think we're going to see some new providers come onto the market, not necessarily specifically in terms of closing, but in a broader sense. And I think that there's some disruptors that are out there waiting to enter. And as we mentioned, the election uncertainty is still out there, but again, for the near future, I see a somewhat continuation of where we've been over the last several months. Patty, if you'd like, you can go to the next slide. Just talking a little bit about digital roadmaps and why they're so important. And if you could go to the slide after this, please. Digital mortgages are here. So when you saw the term hybrid, that really means that part of the process is digital and not human intervened. This is not going away. So, I'll give you an example as well. I bought a vehicle about a year ago. I didn't do anything other than sign an iPad. That was the whole transaction. And so I think to the question about the borrower, I think this is going to continue to be more and more the prevailing theme. I do think borrowers are going to be demanding more of the user experience they want, and also, quite frankly, to dictate the process. So I think that there's some themes around that that are out there. I think if you're a lender or a provider that's in this space, you really need to understand how you're going to move from where you are to where you ultimately need to be, or at the very least, keep up with the competition. And I think that, creating a strategy and a roadmap is going to be key. One thing I am going to emphasize, and Camelia talked a little bit about this, but Maddie, do you have the ability to move back to a different slide in the deck? Can you do that?
Mm-hmm.
Can you go to slide 10? I want to talk a little bit about slide 10. So when you take a look at this, if you look up at the top right of this picture, you're in great shape, right? You're doing everything electronically using the tools, but you can also be in the bottom left and have a lot of things that you need to think about. And for any one lender that does business across state lines, which most do, and many of the larger ones have multiple channels, this gets incredibly complicated. And it's not just, well, I've got to decide if I have this and I do that, then I need to use this path, what have you. The other piece that Camelia noted was things are changing every month. And so not only do you have to keep up with what's going on and understand what you can and can't do, but you have to be very flexible and dynamic. So maybe go back to the slide that we left. For me, it isn't really a technology problem all the time. This is a big time business process challenge, and understanding that ecosystem of providers that are out there. And again, they're also in process of changing and providing additional capabilities. So what we recommend strongly, and Actualize comes out of digital mortgage a little bit differently. We like to start at the beginning and at the end and work backwards to the middle. So if you think about all the capabilities that Camelia talked about, that's getting you to an electronic closing and movement of your assets along to the investor and the servicer. If you think about it the other way around and you start out and looking at it from loan application, the more that you can do digitally and the more that you can leverage data and concepts such as authoritative copies of the data, the less you have to worry as you go downstream. And for those of you in a mortgage shop, you realize there's a cadence that goes on from the loan officer to underwriting to closing and post-closing and things like that. And there's a massive amount of duplication of data and documents and checking and reconciling. And that's why due diligence firms are in business, quite frankly. And I think when you take the digital concepts that you have at closing and you move them backwards and you move your original information forwards, you have a much greater chance to achieve cost savings, you reduce repurchase risk and other problems with the manufacturing process, and that you have a real good chance at making progress in a way that's game changing. Now, when you do that, you have to figure out, well, what's my real return? And if you look at the stats, I think everybody can quote the Mortgage Bankers Association, 9,000 plus to close a loan. But the challenge is that almost none of that number is technology, and most of it is human labor and the ability to capture a borrower to begin with. So we recommend strongly to take a look at your return on investment, look at your costs, and then lastly, don't be afraid to ask for help. I mean, this is somewhat of a shameless plug for both Actualize and Falcon, but we're in business to advise clients and help people move towards a next generation using some sort of digital service offering. But please, and if it's not us, definitely take a look at the market and get some real strong expertise in order to figure out how you create a roadmap. Next slide, please. So, what are some of the things that you would look for in an advisory company? These are things that we offer between the two companies. You want to make sure that you've got a readiness assessment under your belt. Camelia talked about how E can I be? How E do you want to be, and what are your limitations? Put a strategy in place. Go in and get under the hood and look at your processes. Figure out what are all the metrics. Most companies that I know in the lending space can tell me it costs me X amount to originate a loan. When you start asking them questions about, well, where are all the costs within that, and how are they different between offices or within your channels, that starts to break down. So really look at the metrics in terms of the processes and figure out how you can re-engineer them in order to leverage what you can do. In terms of project and change management, most mortgage companies are very good at originating loans. It doesn't necessarily mean they're great at changing, and quite frankly, sometimes being on the inside puts blinders on. So do seek out some assistance in making that change, not just from a project perspective, but organizationally. In general, when you look at this type of implementation, some people need to be repurposed or, quite frankly, let go. If you can automate people out of jobs, that may not be easy. There are companies that can help with that type of change and operational efficiency, organizational effectiveness. Make sure that you've got 100 times out of 100 a good inventory of what the compliance looks like across the different parts of the process and across the states and municipalities. Please look for what technology you have. I have companies that I deal with that tell me I'm on my third LOS and I still don't like it. And when they realize, well, maybe it's not the LOS's problem, maybe I just have the wrong types of technology, or I'm trying to be best of breed, but my technology won't let me be that way. So make sure that you look at that. We do a lot of vendor selection processes. A lot of times lenders and others in the industry are sold technology rather than buying it. So keep that in mind. And then, when you get into the nitty gritty and you need people to help implement the changes and the technology and do the quality assurance, companies like ours are there for that. And the same thing for staff education and training. And so, you may want to dip your toe in the water and do a workshop. You may want to go full bore to looking at a strategy, but please make sure that you're looking at this with assistance from experts in the industry. So with that said, we go to the next slide. And I just wanted to ask Camelia quickly before we get questions from the audience, if there were any key takeaways or things that if people just have one thing to think about on their way out of this webinar, what are a couple of things that you would overemphasize?
Yeah, I think I would just maybe restate something you already said, or is that focus on the process. Recognize that there are impacts upstream and downstream from the actual closing event. And if you start there, everything becomes a lot easier. Change management, the technology selection and implementation. A lot of times when folks jump to evaluating technology providers, you could end up implementing something and realizing, unfortunately, downstream that you're only able to do a small percentage of your closings through it. Or you've done a technology implementation, but you haven't really operationalized the process. So just to reinforce what you said, Matt, about looking at this, approaching this as a business process reengineering exercise versus a technology exercise.
Yeah, and I think the thing that I'm going to leave is that as much as we have momentum, this concept of hybrid is going to stay around for a long time. And so, sure, we're going to start getting to a full eNote. That chart that we saw that was at 4.25 is going to go to 40% and 50 and more. But I think you're always limited by the weakest link, and there are just examples of where some companies won't adopt all of the electronic concepts. And so, don't think that having an eNote and an eVault is the big solution. It's going to take time. And so, it's almost like you're in a continuous monitoring of everything you talked about, the ecosystem, all the counterparties and the tech vendors. This is a complexity that's going to be here for quite a while. And so, I think that companies that are coming in new or that are really re-engineering are probably going to start looking at doing more exclusively digital type mortgages, just because the cost benefits there. And that was, somewhat my take on the new entrants, both tech and lender. But it's an interesting topic. It's one that has been on everybody's mind for a really long time. We got a kick in the pants because of the pandemic, and I think we're getting to be where we're getting critical mass. So it's interesting times, to say the least.
And Matt, we do have a question. It's what are the primary barriers to eNote adoption, and how can those be overcome?
I'll go first, but I want Camelia's opinion too. I think a lot of times it's what I said. It's the weakest link piece, and people think that they have a lot of it solved, but the reality is that you have to orchestrate it through a lot of different parts of the process. And for me, this is why I think just getting to hybrid is so important, because you're getting closer. But I think there's also, the regulatory environment. Camelia, what would you say? You may have a real different view than I do on this.
No, I agree with your view. I think that what's tough about eNote adoption is we talked about earlier, you can only be as E as your counterparties. So, and also you have to look at when a lender, let's put current market conditions aside for a minute, but when a lender would typically be making decisions about which investor that loan is going to go to. At this point in time, you have to know that answer pretty early in the loan origination cycle to be able to determine, can this close as an eNote? Because at least now, the current environment, there's still, GSCs aside, there's still somewhat of a limited population of counterparties that loan can be sold to. You still have to think about, when you start talking about an eNote, can the subservicer you use subservice an eNote? The warehouse lenders, now I think we're up to maybe almost 20, but we still have some warehouse lenders that will not or cannot fund an eNote. So it does still have some limiting factors on your options in terms of liquidity and in terms of counterparties that you can work with. But that, again, like Matt mentioned, is those factors are going to be different for everyone. And hybrids that don't include an eNote might be the right option for you. But going back to your question about eNote adoption, that has traditionally been the biggest barrier, and to a certain extent continues to be.
And I'm seeing one more. It's what's the number one reason why a lender would offer an eNote?
Camelia, take that one. I think that one's a good one.
Well, I don't know that there's like a 1, 2, or 3, but I'd say again it depends on the specifics for the lender, who their counterparties are. Is it part of their strategy to be able to offer a full end-to-end digital closing? Are they seeing significant lifts because of how quickly they're able to move it off of their warehouse lines? It could be a combination of those factors. I don't think there's usually just one. But I think we have seen some counterparties or some lenders start with the eNote, which I think is interesting. I think the reason for that might be, you can do an eNote in all 50 states. It's not recorded, it's not notarized. So some of those same considerations that we just talked about with regards to the recordable docs just don't come into play. So as long as you know that the intended investor is going to be someone that's going to accept an eNote, or for example, you're able to carve out some population of your origination that you know is going to go to the GSEs, then a good common denominator could be the eNote. And you're not going to have to worry about some of those state-specific or county-specific requirements that have to be managed when you start getting into things like with RON and any reporting.
And I think what I'm expecting we'll see is there'll be some lenders that emerge that, and I'm just going to make some of this up, but it tells a story. Maybe I only deal with high net worth individuals with perfect credit and a good down payment and not a lot of risk in writing the loan. And I can do it all digitally, all the way through to an eNote. The cost of doing that loan is so much less than the cost that you would incur if it were a loan with a borrower with poor credit, a low down payment, et cetera, et cetera, et cetera. There's MI, all of that. And so I do think that we're going to see some strategic movement in the lending community to orient towards those, simply because it's an enormous market. There's an enormous amount of business. And if you can do a niche part of the market at a very, very attractive price point, there's a lot of margin in that work. And so I think that's probably something that I think is going to emerge, is that some boutique players coming in that are going to focus on specific borrower types that can leverage the digital. Now, maybe not an eNote, but if you noticed on slide 10 again, there were some NAs on there. Those are situations where there was no note at all. It was a cash purchase, and those can be extremely streamlined if things go well. So we'll see. I mean, got a crystal ball. It's hazy sometimes. I hope there's not any cracks in it, but we'll see how it plays out.
Okay, I'm not seeing any other questions. So if you guys have any last minute pieces of advice or key points, I think we can go ahead and close.
Yeah, I gave mine. Camelia, if you had any last words, what would you say? You may be on mute, Camelia. I'm not sure.
I think the number one saying actually for 2020. No, I don't have any other comments other than to thank everyone for their time and thank you, Matt and Maddie and the folks at Actualize for the partnership on this webinar.
And don't hesitate to reach out to us, even if you're just wanting to explore options or ask questions, we're there. You know, clearly if there's consulting work on the other end of it, we'd love to hear that too. But we also do a lot of volunteer work in the market and try to help educate people. So, you know, to the extent that it would be helpful, just shoot us a note and we'd be happy to get on the phone with you. Thank you, Maddie.
Okay. Yeah, thank you. Thank you everyone for joining us today, and especially to Camelia and Matt for leading the presentation. So if you have enjoyed the presentation today, please connect with Matt and Camelia on LinkedIn, and we'll also send out a recording of this presentation once it's on our website. So hope you all have a great weekend and have a safe Thanksgiving holiday. Thank you, Matt and Camelia.
Thank you.